Hi, and welcome to the Signia Market Review for February 2021. My name is Gregoire Sharma, and I'm the Fixed Income Fund Analyst here at Signia. February proved to be a month of two halves as concerns over too much fiscal stimulus from US policymakers led markets to anticipate earlier than expected monetary policy tightening. Up until recently, bond yields had been trending upwards on the back of rising inflation expectations following these extraordinary coronavirus stimulus measures taken by both policymakers and central banks. However, midway through the month, real yields, which account for inflation and are more reflective of prevailing borrowing costs in the economy, surged 20 basis points, leading to a tightening of financial conditions and weakening investor sentiment. In fixed income markets, with bond prices typically falling when rising interest rates, the global Treasuries index was down minus 1.9% as US 10-year yields pushed through the 1.5% level, climbing over 100 basis points since the record lows of August last year. In the corporate credit space, global indices generated negative returns, with global investment-grade credit down minus 1.4%, underperforming high-yield credit due to the asset class having more interest rate sensitivity. Global high-yield credit finished February flat as rising oil prices and investors' continued hunt for yield helped the asset class outperform investment-grade credit. It was a mixed month for emerging market debt, as EM sovereign bonds weren't spared the effects of the US yield surge. Indeed, EM sovereign debt issued in both US dollars and local currencies fell, with each index returning minus 2.7% and minus 2.4% respectively. EM corporate bonds, which are much less sensitive to US rates, also benefited from the tailwind of higher commodity prices, ending the month down only minus 0.1%. Turning to equity markets, Japanese and European equities achieved the highest returns during February as their highest cyclical content and lower exposure to technology companies contributed to outperformance relative to other major equity indices. The Nikkei and Euro Stoxx indices returned plus 4.7% and plus 4.5% respectively. US equities also achieved a positive return for the month, generating plus 2.6%, though stocks in the technology sector underperformed due to their sensitivity to rising bond yields. Chinese equities were negative as profit-taking and tighter monetary policy weighed on sentiment, with the CSI 300 index falling minus 0.3%. February exhibited a stark dichotomy between styles as value strongly outperformed growth. The latter endured the headwind of rising US bond yields, which weighed on the valuations of technology companies. Confirming this at a sectoral level, value sectors such as energy, financials, industrials and materials performed well, whilst consumer staples and healthcare, which had until recently benefited from low rates, sharply underperformed. Finally, commodities had a mixed month as rising oil demand, fueled by expectations of a vaccine-assisted economic recovery and tightening oil supply on the back of OPEC Plus production cuts, sent the WTI oil price soaring plus 17.8%, its highest level since January 2020. On the other hand, gold generated negative returns of minus 6.1% on the month due to the strengthening dollar, as well as the asset class's negative correlation to real yields. That's it for the month. Thank you for listening and see you in April.